Okay, so let's look at trade payables turnover ratio and let's take it fast. It measures how quickly a company pays off its suppliers or creditors for goods and services, just the same way it is in the payments, trade payables, payment period.
Receivable.
No, not receivables. This one is payables now. So
yeah, it's just like how you I get.
Okay, yeah, just like, okay, yes, you're right, just like the receivables. So this one is payment, just like the payables. Yes, I understand your analogy. So just like the payables, we're looking at how a company pays off suppliers or creditors for goods and services purchased on credit. So where we don't have credit purchases, we just use our cost of sales as usual. It provides insight into how a company's payment habits and the efficiency of its cash flow management in relations to its obligations to suppliers. So I remember in our interpretation of the last ratio, myself and Julie opined that the time it took for them to pay creditors was too long, and they are tying down other people's working capital or creditors' working capital, looking at the length of time, how many days and months it took them to pay off for their credit purchases, which was not nice. So I know it will definitely affect their turnover to see how many times they pay off on time based on this ratio. I'll be examining that very practically. So the formula is clear. The trade payables turnover ratio is the net credit purchases divided by average trade payables. So we're looking at the credit purchases divided by the average trade payables, where the credit purchases shows the total purchases made on credit, excluding cash purchase. So we exclude cash purchase, take note. And the denominator is average trade payables, which is the beginning, plus the ending divided by 2. So
it's credit. It's credit purchase.
Exactly.
Yeah.
20%.
Exactly. Yeah, so we have a caveat there. Total cash purchase is 80 and credit 20. So in our SCI, let me go and pick our purchases. So some companies that don't manufacture, like these ones that normally come in the case study exam, will just have sales or revenue, cost of sales, and we have gross profit. So you just pick the cost of sales as your figure. But here there is a manufacturing company and they have the detailed figure. We have everything given to us. So let me pick our purchases, then I'll stratify the credit in it. Okay, so I have purchases. For the 3 years. So let me take the you have for, that was so fast, I like that. So how many percent? What's the percent of our purchases, please?
For 2021, 22,
okay.
Sorry?
20%. I was asking for the percentage of credit.
That's 20.
Okay. Thank you for that, Salma. So let me have this times 0.20. Good. I have 220 and I have 242, 278, 300. Okay. So let me go get my average trade payables, which is in, okay, so here is it. So I'll pick 44, opening and closing. Okay, so trade payables, let me put this as average. Then trade payables, beginning, trade payables, ending. Okay, so let me have the average. This divided by 2. I have the average as 1,732.50. So let me validate it. 3,465,500 divided by 2. Very correct. Okay, so I'll have this as my ending. Have this as my opening.
How 1.2 to 1.25? Just excuse me for 1 second, please.
Okay, 1.22, 1.22, and 1.25. Salma, what do you have? Are you still calculating? Hello, Salma, are you there?
Yes, I think I have different figure from you people.
Okay.
For 2020, my average is 182,700.
Your average is what?
My average for 2020 182,700.
Is it the turnover ratio now or?
No, the average. That's beginning plus ending over 2.
Okay, for 2020, you have 17 what?
182,700.
How comes? How comes? How comes? How comes we're having differing figures? So 157, 189, 157, 189 exactly. 189, 209, 207. Check your figures. Are you sure you picked the right thing? The trade payables is under your current liabilities.
Let me check my calculator.
Yes, check your calculation. I'm having a different computation here.
I got the same thing. Oh.
You got 117.
157,500 plus
Okay.
189,000 divided by 2.
Okay.
Calculating my
By
end.
2. I have 173,250.
Yes. So let me see.
Yeah, so check
Okay,
again.
okay, I've gotten it. Yes, 173,250.
Okay, kindly validate for 2021 and 2022. So let me get the credit purchases divided by the average trade payables, and I have it as 1.27. 1.27 is to 1. A narrow escape. Yeah, so Julie got the actual figure. Okay, so have you validated your figures? Because I'm in alignment with Julie's figures. Exactly.
Yes, sir. It's just the last one.
Okay, so confirm the last one. So you have 2021, 1.22 is to 1, and
Yes, I got the same thing. 1.248, 1.25.
oh, exactly. Fantastic. That's good. That's interesting. We're all on the same page. Okay, so let's look at what it means. The trade payable turnover ratio indicates how many times during a year or a period the company pays its trade payables. A higher ratio suggests that the company is paying its suppliers promptly, while a lower ratio indicates slower payments or longer credit terms with suppliers. That's exactly what it means. So in this case, well, we won't say it's high, we won't say it's low, but then at least it's better than it's covering the trade payables more than 1. So 1.2, 1.22 is not low, it's not high, at least it's moderate. Let's call it moderate. And the implication is that a company with a high trade payables is managing the supplier payments effectively, positively taking advantage of early payment discounts. So where it has a high payable above 2, 3, 4, yes, so the company is doing well in settling their obligations quickly. Why excessive?
Is it a good report, sir? Is it a good report?
Yes, yes. We're on the same page. You got the figures exactly.
No, I mean interpretation. Is it a good It's a good interpretation.
Yes, I noticed the trade payables turnover is not low, it's not high, but it's moderate. Yes. It's just a bit above 1. So it just covered it 1 time. Okay. And a bit. Yeah, it's a bit favorable.
That so we are paying well and we are not receiving well.
Exactly, and it's not good. If you are paying well, you should be receiving well, because it's from that money you receive, you should be able to pay too.
Yes.
Exactly. So the operating cycle should be balanced, not you are receiving well and you are not receiving well and you are paying well. Exactly. You understand the interpretation. Okay. So we're looking at the implication. Looking at a high trade payables turnover period suggests that the company is managing its supplier payments effectively, possibly taking advantage of early payment discounts. However, if it's paying too early, it might limit cash availability for other operational needs. So the same word comes in here, balance. Balance is very important. And a low ratio may indicate that the company is delaying payments, possibly to conserve cash, but could strain customer relationships. So when we saw the number of days, it was too high and we complained. But the turnover is looking almost moderate somehow. And the cause and effect is that a high turnover, trade payables turnover, shows quick payments to suppliers, favorable payment terms, or efficient cash flow management. So these are the causes. And the effects culminates in strong supplier relationship, potential access to discounts, but reduced cash flexibility. Yeah, so having good supplier relationship is better. And if you balance it, you'll be able to have cash and also be paying on time. So that's where chartered accountants' nobility and the ability to navigate these complex challenges comes in. Why a low one is caused by delayed payments to suppliers, extended credit terms, or cash flow constraints. The effects include strained supplier relationship, potential late payment fees, but most retained cash for other operations. So you are doing it at the expense of the client's business, which is not good. Your business is going on well, but you are scuttling another person's business. So balance is key. So in conclusion, the trade payables turnover help assess how efficiently a company manages its obligations to suppliers. A high ratio demonstrates timely payments and good supplier relations, though it may reduce cash flexibility. A lower ratio may provide credit term liquidity relief, but can lead to potential supplier issue. Balance. You see the word again? Balancing payments to maintain good supplier relationship and cash availability is crucial for smooth operations. This is very important. Very interesting ratios. I love them. And they are self-explanatory. Do we have any questions? Let's run to the last one so that we can enter long-term solvency or leverage today. It's even good. We are running fast. Any question?
No.
No questions, sir.
Fantastic, self-explanatory. So let's go. Working capital turnover, our final ratio for efficiency. It measures efficiently a company or how it uses working capital to generate sales. We're looking at how many times, just like we looked at the number of days in this one. Oh, Aisha is welcome. Okay, so it shows how many times a company's net working capital is turned over in a period, indicating how well the company is utilizing its short-term assets, that is current asset minus current liabilities, to support its sales operations. Formula is clear. Revenue divided by the average working capital. Average working capital, and where your net sales is your revenue, and your average working capital is current asset minus current liabilities averaged over the period. Very simple and straightforward.
Can you explain again the working capital, the formula?
Okay, so we have the revenue as our base, which is our numerator. Then we have the average working capital. So the working capital, working capital management, you're looking at your current asset minus current liability. So anywhere you hear working capital, you just know it's CA minus CL. But if you hear current ratio, it's CA divided by CL. So working capital is current asset minus current liabilities. And if it is not favorable, if it is reverse, then there's problem. You don't have money to run your day-to-day activities. But
What is the average? What is the average working capital?
Okay, so you're looking at the beginning and the end just to have the perfect picture. Just
No,
the same.
I'm coming.
Yeah. Okay.
Current assets.
Oh.
Look at the beginning of the current asset, end of the current asset, or what?
Exactly. So
Then
let's
beginning
look
of the of the current liability, end of the current liability, and divide by 2. Is that what it is?
Exactly. So we have current asset 840 here for 2020. This is the beginning. Then you have for the ending 1.97250.
Yeah.
So this plus this
divided by
is
2.
Divided by 2, exactly.
So it's average current asset minus average current liability.
Exactly. So this plus this, and you come to your total current liability, and you do this minus this. You have the average. Get it now?
Yes, sir.
Okay, fantastic. All right, so let's look at it graphically. It may be a bit complex of a calculation, but then it's easy, but it's not simple. So I'll just take my sales here. I already have sales here, so no need to go to the financials. So I just come here and just pick these ones. Okay, fantastic. So let me zoom a bit so that we can see. Okay, so we have our sales, which is our net sales as this. So average working capital. So I'll prefer us to do like this. Let's make it easier for ourselves because of the average we are computing. So let's have the current assets and we less current liabilities first before we take the average. If we do average of both, it's like we're wasting time and taking longer to calculate it. So let's do it like this. Once we have the deduction of both current asset and current liabilities, we now have the average. I think that would do. Okay, so let's go to the question and pick our total current assets. That will be this. Okay, I think we may have to do it this way instead of doing minus plus plus, since we have the opening and the closing. Michelle is having network issues. Okay, so we have the opening and the closing. So let's say this is average current assets. Let's take this, this. This can be time wasting under exam conditions, shall? Then you have to do it. So stay this plus this divided by 2. Just drag. Okay. So that's our average current asset. Then our current liabilities. Let's have the opening. Let's have the closing. All right. So we have the total current liabilities. We have it as 420. These are the figures. Total current liabilities. Then With this opening, this one's closed. We now have average current liabilities. So 420 plus 420 divided by 2 is the same 420 exactly. Okay, so let me pick this beginning.
I have 2.03 and 2.05. Is that what it's supposed to be? Is that what it's supposed to be?
2 points.
Okay.
Come again.
2.03 and 2.05.
Yes, 0.5. So we're saying 2.03 is to 1, which is revenue.
Okay.
And 2.05 is to 1, which is revenue.
Okay.
How many times? So this is, well, we'll not put the, we'll just call it 2.3 times.
Okay, times. Okay.
Times, yes. That's what we call it.
Okay,
all right.
times.
So, yes, 2.3 times, just like we did this ones. So this one's
and formula is working capital what? Turnover.
Net sales, yes, working capital turnover. Net sales to working capital turnover.
I mean, the name of the ratio is working capital turnover.
Net sales. So this is working capital turnover ratio, exactly.
Turnover ratio.
Yes. Okay, so all these ones are times. Even this one, they are not in ratios, or they are times. Don't forget, this is times.
Okay. What we just, that's trade payables.
All of them, yes, they are all times. We're just looking at how much it is to the numerator and the denominator. Okay, so I have the average and I have the average receivable. So let me do my working capital. Average working capital will now be average current asset minus average current liability. I just drag. Fantastic. So I'll now have the working capital turnover ratio. Quite tricky, and the examiner likes testing it because it will waste your time. He likes testing it. So I'll have the sales divided by average working capital. So this gives us 1.33 times for 2020. So let me drag and see if Julie is correct. Oh, no, Julie, you got something wrong.
Let us see.
You got something wrong.
Let's compare.
So let's compare. Are we on the same page? Salma and Aisha, are we on the same page? Because we're having a debate here with Julie. Are we on the same page?
Sorry, I'm just joining. I just finished from tax class.
Oh, okay. Wow, you had tax class today.
Yes, sir.
Wow, welcome back. Welcome back.
Okay, you had the physical class, right?
Yes.
Well done. All the sacrifices. Well done.
What about Salmat?
Salmat, what do you get? What did you get?
She's not on the call.
She's not in class. But she didn't come back.
Okay, she didn't come back. Yes, I noticed it. All right. So, Julie, will you check where you missed it or where I missed it?
We'll look at it again.
Okay.
Because the formula is current asset minus current liability. Average current asset minus average current liability.
Exactly. So the formula is on the screen. You see it's average working capital, which is current asset minus current liability, averaged over the period. So from this formula, what we did was to take the opening and the closing, and we have the average of current asset. And for current liabilities, we took the opening and the closing, and we have the average current liability. Then we now minus the current liabilities from the average, the average current assets from the current liability, and it gave us
It's
average
okay.
capital. Have you gotten it?
No, Ola. I've not. The current asset I have is let me see.
Yeah, so let's compare the figures. So the current asset figure is 840, 1097, 1217, and 1403.
1097, 250
Yes.
plus 1217, 950 divided by 2. 1157600. Yes. Then
Where did you get
current liability.
Where did you get 1175600?
You know, the current asset, we add the 2 and divided by 2. Divided by
Yes.
2.
Well, how come you're having? Yes, exactly. Well,
Yes.
from my figure, I'm having 1706. Are you sure that's not where you're getting it wrong, or I'm getting it wrong?
Yes. Okay, so let's see it again. Current assets.
Okay, that's exactly where I am getting it wrong.
Okay.
Yeah, so this, the total is 21 because I'm using calculator now, not the Excel formula. So 1097250 divided by 1217950
plus 1217950 divided by 2 is 1157600.
Exactly.
Minus
divided by 2.
The current liability is 420,000 plus 461,325 divided by 2. 440625.
That was where the formula gave me something wrong. You can see immediately I changed
it. So it's okay now.
Yes,
it's okay.
203 exactly. So this first year now, I'm very sure. Okay, Salmat is back. This first year now, 1.36. I'm sure it's wrong because of this average.
Okay.
This average, yes, it's possible it's wrong because 1.3 divided by 2.
It can be corrected. Yeah.
So it has moved now to 2.4 exactly.
Yes.
2.4.
I'm confused. I was glad I got the same thing.
Where were you confused, Salman? Draw us back, guys.
Just happy that I got the same thing. No, I did not do. Is the mistake you just corrected?
Oh, okay.
I did not do I picked asset figure instead of lab. But this is a very okay. I'll correct it.
Yeah, it's quite tricky, and he likes testing this one too because the journey to calculate this is long. The average, the current asset minus current liabilities, blah 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 blah. So take note of it and re-practice it later to master it. Julie really got it. Julie, thanks for that sharp calculation. I wouldn't have known where I got missing in that average current asset. Yes, please, Aisha, go ahead.
To drag you back.
Please go ahead.
How did you get the working capital for trade receivable? Is it trade receivable? Yeah. I've gotten up to the point of average working capital. So it's just the number of times now.
Exactly. Oh, okay. So the number of times will now be your sales revenue or revenue divided by average working capital. This is your average working capital. So this divided by this, you're going to have how many times sales covers working capital. So try it and see.
Okay, I get it.
2.41 times and 2.03 times. Are you okay now, Aisha?
Yes, I am. Thank you.
Okay, fantastic. So let's speak to the numbers. It means that the working capital turnover indicates how efficiently the company is using working capital to generate sales. That's simply what it means. A higher ratio, we consider anchor bid as higher. Well, 2.4 twice is okay, but 3, 4, 5 is higher in my view. A higher ratio means that the working capital is efficiently driving sales growth, while a lower one suggests inefficiencies in managing short-term assets and liabilities. What's the implication? It implies that the company is generating more sales with less working capital. So where you have a high working capital, it speaks to the fact that the company is generating more sales with low working capital. So if we have it at 3, 4, 5, it means sales is more than the working capital and indicates strong operational efficiency.
I have a question.
Yes, please.
The average current liability, this 420 plus 420 divided by 2 is supposed to be 420.
Exactly, the average. Yes.
Okay.
Yes, you're taking the average. Are you okay with that?
Yes.
Okay, fantastic. All right. So we're looking at the implication of a high. However, if it's too high, it may indicate that the company has very little working capital available, which could lead to liquidity risk. So the same word balance is coming here. You don't have a high working capital ratio. Say, for example, 6 to 10. 6 to 10 is too high because it shows that your sales is high, but there's no working capital to drive it. So you need more working capital so that you will not run out of liquidity or liquid cash to enhance sales activities. That's what it means. Why a low one could indicate poor working capital management. If this ratio is low, showing how many times it leads to excessive investment in current assets relative to sales. Exactly. So where you have a low working capital management or working capital turnover ratio, there's excessive investment in current assets and tying down of cash, inventory, receivables in relation to sales. So what is the cause and effect? The causes are efficient inventory management, quick collection of receivables, and tight control of payables. So those three circles are working efficiently if we have this ratio very well. While the effects shows improved sales generation, strong liquidity, but potential liquidity risk if working capital is too low. That's what it means. Why a low working capital turnover will be caused by poor management of inventory, slow receivables collection, or over-reliance on current assets. This is the reason for a low working capital turnover ratio. What are the effects? Reduced sales efficiency, cash flow challenges, and potential strain on short-term operations. This is risky. So in conclusion, working capital turnover ratio is an essential measure of how well a company utilizes short-term assets and liabilities to support sales growth, typically within 1 year. The higher one shows efficiency or the use of working capital effectiveness, but can pose liquidity risk if working capital is too high. Why a balance ratio? So the word balance just permeates all the ratios. Balance is the key, and that's the skill every chartered accountant must have to balance. You need to see how the CEO in my office always questions the finance team's working capital management. It's too high. Invest this in short-term investment, long-term investment, do this, do that. So that's the balance they are trying to create in actual sense, ensuring that you don't have too much cash and you just be spending anyhow. What you don't need, you buy. So that balance is very essential in managing resources effectively while maintaining sufficient liquidity to meet short-term obligations. So this is key, and chartered accountants, this is where we come in. We need to really strike that balance. There are times when they want to buy something, the finance manager will say, no, there's no money. In actual sense, there is money, but then that purchase is not exigent, it's not necessary at that time. And that's where you come in with decision making to say, no, looking at what we have. This is not pressing, this is to be paid, this is to be kept. And at best, you are enhancing your working capital management, and that skill cannot be, is not born, you are not born with it, you develop it as you work day to day with the situations in your internal environment, your cash flow operations. You are able to examine and use these ratios very well to help enhance the operations of your office. Very important. Okay, so there are ladies. I'm not. There's no. I'm the only gentleman here. Ladies, we are done with efficiency or activity ratios. So, any questions so far? Any questions?
No. The explanation you just gave was working capital turnover ratio.
Exactly. Exactly. Okay, I believe that's clear enough. And what's the time now? We have 10 minutes to go. Okay. Yeah. So let's introduce long-term solvency and leverage ratios very quickly. So if we introduce it, I think we'll close, because tomorrow's class we are going to have the mock exam explanation of audit. And on Thursday, we'll have the first mock exam explanation of case study. So tomorrow, prepare. We don't have advanced audit and assurance lectures. We have the mock exam explanation and the solutions. I'll be sharing the solutions and look at how to approach most questions. So I don't want to go into it detail tomorrow, because I saw a lot of things in your scripts. I will explain them tomorrow to help you. Yeah, because like when you are writing when you are taking a paper like AAA, you have to start each question on a fresh page, and most people did not do that.
On a fresh page.
Exactly. Yeah, start every question on a fresh page. So you finish number 1 and you're going to number 2. Under number 1, you start it. I mean, it makes your work untidy. It may not reduce marks for you, but you get the examiner. So those nitty-gritties, we'll talk about them in detail before we go into the question tomorrow. So let me don't deviate to advanced audit and assurance. Let's stay with case study. We'll look at all that tomorrow. I took note of that in all the scripts that were submitted. Okay, so we don't have any question. Let me quickly share the slides for efficiency, long-term solvency, and let's look at the brief introduction to that subject quickly. So let me quickly share the slide and talk about long-term solvency. Okay, so we're looking at long-term solvency or leverage ratios. So long-term solvency, look at ratios that are above a year, 5, 10, 20, or 5, 10, 15, 20 years. So these ratios are not short-term solvency ratios like liquidity ratios. Liquidity ratios are short-term solvency ratios, while these ratios are long-term solvency or leverage. Leverage meaning the balance between equity and debt, and you are leveraging both external and internal debt to balance your capital structure. That's what leverage means. When you look at a lever stands to help you balance something. So you're not having too high of debt or too high of equity, and that's what leverage means. So that synonym is used for long-term solvency, because long-term looks at a year and above, nothing less than a year, while liquidity or short-term solvency looks like a year and below. So these ratios, in terms of long-term solvency, evaluate the proportion of a company's capital that is financed through debt versus equity. Exactly. So we are typically looking at external financing, which is debt. Take note of that. And internal financing, which is equity, helping to determine the level of financial risk. So the company will be too exposed if the shares or the ownership is owned by outsiders. The risk is financially high. So where you have 80%, 60%, 70% of your capital structure as debt, man, is high. But where you have 50, 50, 40, 60 in favor of shareholders or equity is safer. The financial risk is lower. So long-term solvency ratios help us to look at this financial risk associated with a company's capital structure. This is very important. So investors, creditors, and analysts use these ratios to assess the company's leverage. They assess the financial stability and long-term viability. How long you are able to weather the storm in the long run. Are you sustainable? Is the business sustainable? Is the business able to stand as a going concern? A going concern is looking at a business that could survive the test of time in perpetuity. Not a business starts in 5-10 years and is shut down or close up or files for bankruptcy, is insolvent. But we are looking at financial viability and stability in the long run. This is very important. So by undertaking long-term solvency, stakeholders can make informed decisions regarding investment risks, creditworthiness, and the company's overall financial health. So long-term solvency is very important, and your debt or your capital structure determines this expressly. It has nothing to do with working capital, day-to-day running. No, you're looking at your debt and your capital structure, how you're able to inject capital, how you're able to source for funds to run the company, because these are heavy investments. And investment risks, analysts and investors will look at some parameters and some of these ratios to be able to say, okay, let's inject our funds into this company. And the injection of funds and getting credit or your creditworthiness really determines the overall financial health of the company. So it's very important, and that same word comes to bear here: balance. Balance between equity and debt. So every of the ratios we'll be calculating revolves around equity and debt. Equity and debt. How the company is highly geared, because the first ratio we'll be calculating is capital gearing ratio. Capital gearing ratio. We'll be looking at two variants. We'll be looking at the debt to capital and also the capital gearing ratio. One has to do with looking at how much debt is much and how much equity is much. So when we come to in the next class, we'll be looking at that very graphically. So these ratios are important, and the examiner tests them. In fact, your first mock exam, there's gearing ratio there in that mock exam you saw. There's gearing ratio, looking at how the company is or the bank is highly geared. So pay attention to that when we come to the calculation of the gearing ratio and how it's applicable very practically in the next class. Okay, so we have 3 minutes more and we've exhausted this introduction. Yeah, it's good we land safely here. So any questions so far?
Nothing for me.
Don't tell
But
me
you're
you're
going to
anxious.
share.
So, sir,
You're going to share this material.
Sorry, Julie, hope you're not running to go and sleep quick.
Oh yeah. Oh, my eyes are wide open.
Okay, fantastic. Of course, I'll share the material. In fact, I'll share this one. I'll share the full of this leverage so that you can go through it before the next class. It's better.
Yes,
I'll
sir.
share activity, efficiency, and I'll share long-term solvency, share everything on the platform so that the next class will just follow, we'll just sail through together as we are looking at it. Okay, so Aisha, sorry I got you.
oh no,
You're trying to
I
say
was
something.
faster. So the summary of gearing leverage is that
Yes,
it's a company should looks at the balancing of debt to equity.
exactly. Exactly. That is just
That's
it.
what I just want to get. And it shouldn't be more than
Yes.
50%.
Yes, 50-50 at best. But then you always want shareholders to carry the chunk. So in practice, it is advisable that maybe they have 60-40. So let it not be 50-50 and something happens, they slide into maybe 40% and outsiders are owning your company more than you. It doesn't, it doesn't over.
So that
discuss
that
this
that
thing
like
too
that
much. You know, I've
explains
not
the
done my
quick
assignment.
ratio of 2 to 1.
Something like that, exactly.
Okay.
And you also need external finances. Some people will advocate that, okay, let our capital structure be total equity. It's not too nice because expansion and some other things. We'll be looking at the ratios. It's not too good to have totally your equity as your capital structure. It's good to have some mix of debt. Yes, have some mix of debt so that it will help you in terms of, okay, we want to expand, we want to retain money, we want to have more shareholders on the board or on our shareholders structure or stakeholders of the company. You just bring in debt, but let it not be too much. So the mix, like the word we always use, is balance. Make sure you are mixing it well and you are balancing. And some companies, limited, they will tell you they don't want external people, they don't want dilution. They want to be the owners of their company 100%. Well, that's their choice. But in a real business scenario, it's good to mix equity and debt. The company becomes larger, expand, and have it goes wider in reach than if you look at examples of big parastatals or companies like Apple, Facebook. You see that it's not only Zuckerberg that has shares in the company, he has debt. There are external people that invest and they get interest, but then he has a larger share. I think Zuckerberg has 51% of Facebook. So other shareholders are there and other debtors too are there. So the balance is always good, and that's why they have wider reach. They go global. They are multinational companies, but most of those companies are saying we are just equity owners. They stay within a particular region. They just maybe end in Africa because they refuse to have international affiliations and debts and investments from other investors and all that. So we're looking at that in detail, and it's an interesting
okay.
subject.
Let me know ask further questions and suspend it till then.
No, please go ahead. We have how many minutes more? Okay.
It's 10:01.
It's
We
10.
don't have it's 10 o'clock. Oh.